Everyone is watching the AI bubble, waiting for it to pop. But on the other side of the Pacific, something quieter is happening. Japan has been America's most loyal lender for almost 40 years. That loyalty is starting to break. And if it keeps breaking, it could hit the bond market faster than any AI crash ever could. To understand why this matters, you need to understand one simple relationship. The United States borrows money by selling government debt, called treasury bonds. For decades, Japan has been one of the largest foreign buyers of that debt. Japanese banks, insurers, and pension funds held trillions of dollars in U.S. treasuries. In return, the U.S. got a steady buyer, and Japan got a safe place to park its savings. This relationship was so stable that almost nobody questioned it. It was treated like a law of financial gravity. But starting last year, that quiet assumption started to crack. For the first time in decades, interest rates inside Japan began to rise. At the same time, the Japanese yen has been historically weak. That combination changed the math for every big Japanese investor. Why hold U.S. bonds and take on currency risk when Japanese bonds now pay almost the same yield at home? So Japanese institutions started doing something unthinkable a few years ago. They began selling U.S. treasuries and buying Japanese government bonds instead. This isn't a rumor, and it isn't a conspiracy theory. It shows up directly in the flow of funds data every quarter. Here is the part most people miss. The entire U.S. Treasury market runs on one core assumption. There will always be enough buyers to absorb new debt. The U.S. government doesn't just borrow once. It constantly issues new bonds to pay off old ones. Month after month, year after year, as long as demand stays strong. Interest rates on that debt stay low. But when one of your biggest buyers starts selling instead of buying, the balance shifts. And Japan doesn't hold a small position. It holds more than $1 trillion in U.S. government debt. Even a slow, orderly reduction in that position adds real selling pressure to the market. This isn't the first time a major foreign buyer has pulled back. China quietly trimmed its own treasury holdings over the past several years. Each time a major buyer steps back, the U.S. has had to lean harder on other buyers to fill the gap. The Federal Reserve, domestic banks, and everyday investors. But there's a limit to how much slack the rest of the market can absorb. Every past pullback made borrowing slightly more expensive for the U.S. government. This time, the pullback is coming from the single most consistent buyer America has ever had. So what actually happens if this trend continues? When demand for U.S. bonds weakens, the government has to offer higher interest rates to attract new buyers. Higher rates on new debt sound small until you see the scale. The U.S. already spends more on interest payments than it spends on national defense. If rates climb further, that interest bill grows even faster, and that money has to come from somewhere. Either taxes go up, government spending gets cut, or the debt keeps growing to cover the difference. None of those options are politically easy. This is exactly the kind of slow-moving pressure that doesn't make headlines until it suddenly does. Now here's why this actually affects you. Even if you've never bought a single treasury bond in your life, U.S. Treasury yields are the baseline for almost every other interest rate in the economy. When Treasury yields rise, mortgage rates tend to rise with them. Car loans, credit cards, and business loans all get pulled higher too. Even if the Federal Reserve cuts its own short-term rate, long-term borrowing can still get more expensive. That's the disconnect most people don't see coming. Higher borrowing costs slow down the entire economy, from home buying to business investment. And if the government responds by printing more money to cover the gap, that quietly erodes the value of the cash you're already holding. Now, to be fair, this isn't happening overnight, and it isn't guaranteed to spiral. Japan is reducing its position gradually, not dumping bonds all at once. Other buyers could still step in to fill part of the gap, but the direction of the trend matters more than the speed of it. For the first time in a generation, one of America's most reliable lenders is quietly becoming less reliable. So the real story isn't whether the AI bubble pops. It's what happens when the buyer who's been quietly footing the bill for 40 years finally stops raising their hand. In the next video, we're breaking down who inside the U.S. could actually step up to fill that gap, and why the answer might surprise you. If this helped you understand something you didn't know before, subscribe so you don't miss it.